Hello everyone, welcome to this trade management mini session. My name is Barbara Armstrong. Today we are going to look at an example trading plan. The trading plan we are going to look at today is a long call with a 1 ATR target. I know that we have limited time together, so I want to get right down to business. So I invite you to join me in the land of X. If you haven't done so already, you might want to follow me. My handle, BarbArmstrongCS, which you can see on the screen. Before we get into our example trading plan, I just want to quickly clarify a few things. One is that options carry a high level of risk and aren't suitable for all investors. You have to apply for option trading privileges with Schwab and not all will qualify. The second thing is that the paperMoney software application on the thinkorswim desktop is what we're using as our example platform for today. It is a brilliant place to learn and hone your skills. I'll also know that all investing involves risk, including the loss of principal, and that past performance of any security or strategy doesn't guarantee future results or success. So I'm going to come over to a Microsoft Word, and this example trading plan of a long call with a 1 ATR target, what is that all about? Well, this is a bullish trading strategy where we're looking at a stock that is uptrending. And let's just take a quick walk over to our thinkorswim desktop platform. We are going to look at, for our example today, Morgan Stanley. And I have a 1-year chart up. We can see that Morgan Stanley is up almost 10% year to date. It has just had earnings and had a pretty solid earnings report. The market pulled back for a couple of days and Morgan Stanley pulled back with it. And we can see that today we have this bullish pattern where it's pulled back to a support level and appears to be bouncing. When we take a look at the last year, this stock is up about 8%, but we can see that since October of last year, it's been uptrending, spent a bit of time going sideways and uptrending again. So if we were bullish on this stock and said that we would like to do a short-term trade, this type of strategy is one that we might want to consider. So let's come back and say, well, what are the components of a trading plan? Well, let me just bring this back down. Okay, here we go. So the 4 basic components are what to trade, when to trade or when to enter the trade, how much to trade or position sizing, and when to exit. So what components might be part of what to trade? Well, this is a bullish strategy. So when we're looking at what to trade, we're looking for a stock that is uptrending. In other words, that is gaining in value. Now, some people may also say, I would like to see that the sector is uptrending and that the market is uptrending also, because if all of those things are in alignment, some traders might see that as a position of greater strength. And some people will even create a checklist and kind of go through. And it's not that you can't do a counter trend trade, but if you're looking to take advantage of the flow of the market, this might be something you'd want to consider. In addition, you may say, well, not only do I want the stock to be uptrending, I want the stock to trade high volumes. And how do you define high volume? Well, you might say, well, I define that as 1 million shares a day or more. And some people might say 5 million shares a day. That's totally up to you. And you might say, well, we're looking at an option trading plan. Why do we care about stock volume? Because if the stock has high volume, then the options are likely to have high trading volume as well. And how do we define that? Well, you might say for that you want this to be at least 20 times the number of contracts being traded. And you will see that on the platform under open interest and volume on the option trade, on the option chain. Now you might say, well, I don't really care about that as long as there is a tight bid-ask spread. And what do you mean by bid-ask spread? It's the difference between the bid price and the ask price. And you might say, as an example of a rule, that you want it to be less than 10%. Others might say 5%, and some might not have that as a guideline. And then some might also say earnings you want to avoid, or maybe earnings or big announcements. Now others might do this as an earnings trade, and that's totally up to you. But if you're trying to do this in a conservative way and you want to avoid gap risk, you may want to avoid trading this over those periods of time. So now second component might be, when do you place a trade? When, what would you consider an entry? And so what we're looking for here is a bullish entry. Now on Morgan Stanley, we looked at it and said, well, it broke above a support level and came back. It broke above a resistance level and came back and retested it, and might be bouncing off a support level. So a bullish technical entry could include, and this isn't, all of them, but it could be, a breakout above resistance. It could be a bounce off a support level. It could be a bull flag entry with what they call a hold, or close above the high of the low day. So this is an exclusive list, is not an exclusive list, but it gives you, a few ideas that you can start from. But we're basically looking for something that is uptrending and that has just bounced off a support level or broken out above resistance. Now, when it comes to how much to trade, this is really our position sizing. And so when we look at position sizing, we want to define what our max risk per trade is going to be. And so for some people, as an example, it could be a finite number. So it could be, $1,000. It could be $200. In our trading a smaller account, we had a $500 is our max risk per trade. Or it could be a percentage of the account. So in our trading a smaller account, we started with 2%. And you might say, if I had $1 million account, there's no way I'd risk 2%. It might be half of, 1%, or, a third of 1%. Oops. A third of 1%. Okay. Or it could be 1%. I mean, it's up to you. These are just some ideas. And one thing to consider is, if you had 5 or 6 or 7 trades go wrong in a row, would you be okay with taking that max risk? And if not, your number may be too high and you may want to, lower it a bit. Now, the last part, and certainly not the least important, because this will make or break many traders, is considering when to exit. And I always say you should know when you're getting out before you place the trade, no matter what type of trade you're placing. And so you might say, well, in this case, if I'm placing a 1 ATR trade, I want to exit, when it hits the 1 ATR target, or when it hits the 1 ATR exit or stop. But what if it doesn't hit the target or the exit and it just kind of lollygags about in between? Well, we don't want that to happen either, because then we've got time decay that's an issue. So, as a daily management process, you might say, If it doesn't hit the target after the market close, I'm going to adjust the stop or the exit daily to, and then it depends on the price of the stock. So you might say, if the stock is $50 or less, to 20 cents below the close, below the closing price. And then you might say, well, if the stock is, sorry, my typing skills are modest here. If the stock is between, 50 and 100, then you'll make it, let's say 50 cents below. And then if the stock is over 100, you might want to make it $1 below. Now today we placed a trade on a stock that was around $500. And so we said, well, we're going to make it $2 below the closing price. These are all closing prices. Below the closing price. And so this gives you kind of a framework in which to place the trade. So if we come back and we go back to a potential example here on Microsoft, the idea is that, and we're going to look at a shorter time frame, we're overall bullish on this stock. It's been uptrending here since February, basically, with a little period of consolidation. It's come back. It broke out above this resistance level, came back, and appears to be bouncing off this support level. And this pattern is called a harami, or this candle can stand on its own also. And so if we look at this and we say, well, what is our ATR? And if you don't have that on your chart, average true range, it tells us the amount the stock, this particular stock, has moved in an average day over the last 14 days. And to add this to your chart, you just come to Studies, Edit Studies, click on ATR, and if you click on this question mark, it'll bring up a much more refined definition of what this is. But you'll notice that it says here ATR 14. So that means that this is the average amount the stock has moved from top to bottom, and it also compares it in relation to the candle of the day before over the last 14 days. And so I already have this on my chart, but on average, this stock has moved over the last 14 days about $2.25. So we are going to buy a call and say, hey, if it goes $2.25 above today's high or $2.25 below today's low, we're going to, exit the position. And so here's our example. And on Morgan Stanley, our one ATR is $2.25. And so our target is going to be, and just by hovering over the candle, you'll see that high for today is 103.23. And we would add 225 to that. And that would give us a target of 105.48. And if it goes down and hits our exit, which we don't want it to do, but it has happened, 101.95, which is today's low, minus 225, would give us an exit of 99.70. Okay, so we're going to come to our trade tab. We're going to come out, and we could look at August, which is only 25 days, or we can come out to September. So if we look at September and we look at the money strike and we go back to our trading plan, does this trade more than 1 million shares a day? And so if we look at that and we would say, well, yeah, if I look up here, that's 3,000,006, check. Do we have, if we look at the money strike, do we have at least 20 times the number of contracts we're looking at trading? Well, we're going to do one contract, maybe two, so check. Is the bid-ask spread tight? So if it's a $2 option or a $2.35 option, we'd want it to be 23 cents or less. The bid-ask spread is 3 cents, so check. So we've got check, check, check. And then on a technical entry, was the stock uptrending? Yes. Was it bouncing off a support level? So we have a check there. Had it recently broken through a resistance level? Check there. Now the next step is position sizing. So we have a $35,000 account, our smaller account. We don't want to risk more than about $500. So if we did two contracts here, that would be just over 500. So would we be okay with that? Because how much could we lose? The entire amount. Yeah. So we are going to close out my drawing tool. We are going to click. We are going to buy a single option. And this is just a quick way to put this in. We're going to come down to advanced order, make it a first trigger sequence, right click, create an opposite order. We're going to buy two of these, and then we're going to make this a market order to exit, and we want to get out when it goes at or above 105.48. $105.48 at or below 99.70. Now, do those prices make sense? Where is it trading now? 102, so that's about $3 it looks like above, or a couple of dollars below. Save. When we come to confirm and send, how much are we risking? $476. How much could we lose? $476. And then we want to exit if it goes above 105.48, check, or below 99.70, check. Now, what will we do with this tomorrow? Well, tomorrow after the market closes, we'll look at this. If it hasn't hit our target, then we're going to move the stop up. And so this is where we have the most risk, is on the day we enter the trade. Of course, it could gap up or down at any time. There's no guarantee that we'll get filled at these prices, the prices that we've requested. But there's our one ATR target example trade. And we'll send that in. So again, I hope you have found this helpful. And this is just, you know, a framework that you can use to create your own example trading plan. So I hope you found this helpful. Thank you for joining us. Remember, example trading plan, example trade on Morgan Stanley. And I hope you will join us in a class coming up soon. Take care, everyone. Bye for now.